Hello and welcome to the Solve to Evolve podcast. The purpose of this podcast is to share our knowledge and insight to help individuals and business owners learn and grow. Hello and welcome to another episode of Solve to Evolve. This is episode 3. We're really going to dive into the frequently asked questions from our clients. We just really want to make sure that we are solving or answering their questions. And so in today's episode, we're going to start off with talking about business structures and how important that is when operating a business in Australia. Now, Chris, you started Solve back in 2010. There's obviously different types of business structures that you can, or tax structures that you can operate a business in. Why did you choose company instead of, a partnership, for example, where traditionally accounting firms would operate in?
That's a good question, Phil. And you've pointed out something correct, which is that a legacy structure for accounting firms in this country and globally is the partnership. So a key element of a partnership is a thing called joint and several liability. So if one partner does something bad, all partners are on the hook for that mistake. With a company, you don't have joint and several liability. It's what's called limited liability. So the shareholders' liability is limited to the capital that they have invested into the company. That is one key reason why Mark and I chose to incorporate rather than operate as a partnership for Solve. A second key reason is because of something that we weren't deeply aware about before we started the firm, which is that companies can have different classes of shares issued. And on those different classes of shares, the company can declare different dividends to different shareholders. What I'm specifically talking about is a thing called a dividend access share. So in Solve Accounting, for example, even though we all have ordinary equity, there may be a new practitioner we want to bring in and give the company the right to distribute profit to that practitioner based on how they perform on the P&L, but not necessarily control over the strategic direction of the company early in the piece. So the beauty of a company is that with different classes of shares, you can achieve different objectives, whether it be control or distribution of profits on top of the limited liability. The third reason why we use the company is because it puts legal distance in between ourselves and our suppliers, our employees, our clients. That legal distance is important because operating as a partner in a partnership, you are personally liable for any errors that entity makes. And we did not want to expose ourselves personally, our personal balance sheet, to business risk. So that's the big picture summary of why we chose the company to operate Solve Accounting through.
Yeah, thanks, Chris. I think you touch on a really good point, and I think that's being able to set ourselves apart from suppliers, because obviously, if someone was to make a big mistake in a partnership, everyone would be up for it. Whereas in the company structure, we separate ourselves and we've got that limited liability. I think the other thing you probably didn't touch on, but we can go into more details later, is imputation. The franking credits that we all receive through the company. But let's move on to Jono for a second. So Jono, you've recently worked with a client who was operating their business in a partnership structure, and then you helped them move into a company structure. Can you provide more information about that scenario there and what happened and what is involved?
Yeah, so that particular client started life as a partnership. It was just two friends who started a business during COVID, and it scaled up quite quickly. They didn't do any thinking about, like Chris and Mark did back in the day, about what structure to choose. And sometimes that happens for a lot of startup and small businesses. They'll start with a partnership if it's more than one person, or a sole trader, just because it's easy, it's less complicated. There's nothing to think about from a legal point of view and setting up a structure. So what we did with that client was, because they were growing so fast, they were starting to take on more commercial risk. So that was things like commercial leases, suppliers, things like that. So what we did, and this can be done under the tax law, is, so ordinarily when I move a valuable asset from my hands into a company or some other entity, there's a gain on that transfer. There may be tax on that. What I was able to do for this client was roll everything up from the partnership, which was the business, the assets, the goodwill, everything related to that business came up into a company in which they held 50-50 shares rather than as 50-50 joint partners. And that was a really efficient way to move them into a structure that can scale, that can take on debt if they want to, that can pay them a salary and a wage. So in a way they separate themselves from the business risks, and they're also able to be paid out of the business and have the company bear that burden rather than themselves personally, which is a common issue we can talk about later with tax payments. But that was a good outcome for that client who just started up without thinking about these structuring implications. And on that point, another thing to consider when you're doing a business restructure, there's also state taxes that you need to think about. So there are income tax exemptions. So when you roll, for example, from a partnership to a company, we can use the tax rules to say that there's no capital gains tax on the goodwill. That's fine. That's at a federal level. But then at a state level, we also need to be aware of stamp duty on business reconstruction, it's called. So for most states in Australia, we can approach the State Revenue Office and ask for a corporate reconstruction relief, which can be done when you're transferring a business into a company from a partnership.
Yeah, that's right. I think you make a good point. A lot of people do get into business and they just dive straight in. They don't think about anything else. They just go, I've got a good idea, I can make the money, and they do that without thinking of, the structure implications and the tax structure and the implications, really. Can you touch on, Jono, a little bit about the tax rates for the different, what are the different business structures or tax structures that a business could use, and what is the tax implication or tax rates for each of those?
So on the one side, we've spoken about sole traders and partnerships. Those really aren't structures per se. Maybe a partnership is a structure where it's formalized and there's documents, and for a professional partnership, for example. But where it's just two people carrying on a business, it's not really a structure per se. In those scenarios, the tax rate is really going to be whatever the individual's tax rate is. So that's as high as 45% plus 2%. Call it 47 for once they're earning over $180,000 in profit. So that's one scenario. The other scenario is using a structure. So there's two main structures for business. You can use one of these, either or a combination thereof. The first one is a company. So we've mentioned companies. The benefit of that is they have a flat tax rate. So at the company level, they pay 25% for businesses that are under 50 million turnover within a company. They're going to pay a flat rate of 25%. And the company is going to be the entity that meets all the tax obligations. So, as I've mentioned in previously, there's really three types of tax to think about, which is the sales tax, which we call GST, the employee tax, which is taking tax out of employees' wages and paying it to the ATO, and the income tax, which we'll get into more later. There's also trusts. So trusts are a little bit different in that they are a separate entity, but the profit of the trust can be paid out to whoever the controller of that trust chooses. So the controller of the trust is called a trustee. That can either be an individual or a company. For most businesses, they might set up a company as a trustee just because it's easier to have that on the name of legal documents. And that trust can then on distribute to other companies. You might have heard the phrase of a bucket company. That's literally a company to house profits at that corporate tax rate, or they can pay out the distributions of profit to the business owners. And there's flexibility. So the benefit of a trust is flexibility, but it won't pay tax on behalf of the business owners, at least initially, like a company will.
No, got it. So it sounds like or what you're saying there is the trust has more flexibility in terms of distributing income to save on tax. But I mean, Chris talked about dividend access shares. That effectively allows a company to do the same thing, doesn't it, Chris?
That's correct. Using dividend access shares effectively and splitting the P&L on the franking account based on practitioners, for example, it serves the same purpose and you achieve the same outcome from a tax point of view using the company that way as you would distributing through a discretionary trust.
Yep.
Yet another benefit of using the corporate form with the added understanding of different share classes.
Yeah. No, it can get quite complex, and that's why we need, tax accountants that really know the tax law to really help business owners on that. I wanted to go back onto a point we briefly touched on, and that's imputation system, or the franking credits that can be derived from a company. Can you tell us a little bit more about the franking credits, Chris? In the simplest terms?
I feel I can tell you a lot more about franking credits and dividend imputation.
Please do share.
For Australian resident taxpayers, apart from one other section, 8.1 and 6.5, which are what are called gateway provisions to the tax law, probably the most important thing to understand is the imputation system. Effectively, what it does is it integrates the tax paid by the corporate tax entity with the tax that has to be paid by the shareholder on distributed profits. A simple way to think of it is that a company pays income tax of X. The full amount of that X is refundable to the shareholders through a mechanism called gross up and offset. There's no easy way to explain franking credits. It's a complex situation because a franking credit is both statutory income, but it's also what's called a tax offset, or in the old terminology, a credit.
Guys, is there a way that you can put that into an analogy? Because listening to that as someone who's not an accountant, I'd love just some sort of an analogy.
My analogy is that imagine a really big truck driving through a toll gate.
Yeah.
The toll for the truck is $1 million because it's huge and it's crushing the road, and it's going to cost a lot of money to fix up all the damage that the truck does to the road. But the catch is that there's 1 million motorbikes riding behind the really big truck, and they actually get paid to drive on the road. They get paid $1 each. So the $1 million paid by the truck at the start is refunded $1 at a time to the 1 million shareholders on motorbikes behind the truck. The net take to the toll booth operator is zero, because even though they take $1 million from the truck, they have to refund $1 to the 1 million shareholders behind the truck.
Yeah.
So if I was to ask you a question, does a company pay income tax? What would your answer be to that?
My answer would be a qualified no. In Australia, companies do not pay income tax, and I can prove it. The way that you prove it is by looking at the credits and debits in the company's franking account. Now, those franking accounts are not required to be disclosed by listed entities, but for example, if you're interested, you can look at a contribution report by, for example, Wesfarmers. So my position is that the income tax paid by the head company of that consolidated group is not a contribution because it is refundable to the shareholders of that company. And the same logic applies all the way down from BHP or Commonwealth Bank, right the way down to Solve Accounting Proprietary Limited. Okay, the rules are the same. The tax on corporate profits, if the franking account is understood and managed correctly in this country, is effectively zero.
Right. So
At the company level.
The company does pay income tax. There is a corporate tax rate. As you correctly pointed out before, base rate entities pay tax at 25%, non-base rate entities pay tax at 30%. So income tax for companies does exist, but when it is paid, whether that be in installment form or on a lodged return, it creates a credit in that corporate tax entity's franking account. That credit is only debited when an imputation benefit is attached to a dividend that is distributed to a shareholder in that corporate tax entity. So the way that you can prove that no tax is ultimately paid by companies in Australia is by linking the payments that create credits in the franking account to the dividend declarations which create debits in the franking account. And over time, they should level to zero. A number of things happens inside franking accounts which may result in a non-zero total at year end. But over time, the answer to the question is that there is ultimately no income tax paid by corporate taxpayers in Australia because of the imputation system.
Okay, so when a company pays tax, if used correctly, the individual shareholder can get that company tax credit in the individual name.
Correct.
Great. All right, guys. So a lot of business owners do operate their business through a company structure. And I think a couple of main or common issues that they would experience is, one, how do they actually fund that business? Jono, do you want to touch on that?
Yeah, sure. Thanks, Phil. So really there's two ways for a business owner to fund the company. That can either be done by equity. So what that means is buying shares in the company. That's equity. There's also debt. So similar mechanics, you put cash into the company's bank account, but in the accounts, we treat it as if you were loaning that money to the company. So the same as if you put money in a bank account, that's a liability of the bank. If you put your cash into your own company, it's a liability of the company to you. So let's talk about the loan first. So you've loaned money to your company. It's done really well. You've made profit. You pull some money back out and put it against that liability. That's not taxable to you. It's just money in, money out, no tax to pay on that. Happy days. When we're talking about equity, it gets a bit more complicated. So I have share capital in the company. To get that capital back out, depending on what the company's balance sheet looks like at that time, I need to do what's called a share capital return or a return of capital. Big companies, use that terminology, and it applies to private companies as well. So it's a little bit different, a little bit more to think about, especially if there's profits in the company. Returning capital can be a bit more complicated. So that's something to think about when funding your private company. The other thing, talking about loans, so where it goes the other way. So the company's running your business, it's going really well, and you start pulling funds out of the company to fund your personal lifestyle, your cars, you're putting your kids through school, whatever. You can end up where you owe the company money. So that's what us accountants would call it a debit loan account. All it means is you owe the company some money because you've taken out more than you've put in. In that case, there's a common tax problem that applies to business owners of private companies. It's called Division 7A. What it tries to do is where you've taken out profits from a company or access profits, that might be by taking out cash, using an asset of the company, so a car or something. There's other payments as well that it can apply to. In that case, what the tax rules will come along and do is call that a dividend. So if I'm the business owner and I've taken out that cash, it's still sitting there at the end of the year. Assuming I do nothing with my accountant to work it out, I'm going to be taxed on that then and there by the time I lodge my tax return. So there are ways of dealing with it. What we normally do as an accountant is call that loan a commercial loan. So we'll say, let's treat that loan as if it's on, I'm taking a borrowing for 7 years and then I'm paying some interest and repayments back to my own company. That's one way of dealing with that issue. But it's a common one that I see with almost every business owner with a company and that we have to deal with.
That's right. I think you touched on two important points. The first one is when setting up the company, it's important to understand whether you're going down the debt or equity route. And I think there are small business owners out there that go ahead and incorporate their own company without knowing the impacts of what they may have done. Right. So that's one point. Yeah. The second point is borrowing money from the company. People need to understand, business owners need to understand that a company itself is a separate legal entity in the eyes of an ATO and from a legal standpoint. Yeah. And so, if you are drawing funds from the company itself, you need to be aware of Division 7A to ensure that either you have a commercial loan agreement in place, so you're not, breaking any tax laws, or, declaring a dividend to clear that down.
100%, yeah.
Right. Chris, do you have any points to add on that, or was that nicely summarised?
I'd say that it's not inherently evil for a business owner who operates their business through a company to borrow money from that company to live on. That's not the mischief that the tax law is trying to curtail. Many private companies have business owners who borrow from that company and then declare a dividend on the following 1 July to clear the debt, as you said. That is an extremely efficient way for a business owner to operate, because not only do you avoid payroll on costs, but you also can utilize the franking account, which is a critical step that a lot of even accountants miss. The number of times that client work has hit our desk, Phil.
Yep. See it all the time.
Where the franking account has been mismanaged really signifies to us that even trained accountants, even some qualified accountants with postgraduate qualifications, members of respected institutes, get it wrong.
Yep.
Business owner clients of mine often have to have explained to them the pros and cons of using dividends, loans that are then declared as dividends the following year, versus using salary or wages to extract their cut of business profits from the company. The way that I respond to them is, first of all, what I've just said. So using a loan dividend scenario is much more administratively efficient and it's less artificial, because for a small business owner who it may be the only shareholder in a company, to enter into an employment contract with that company is fake.
That's right.
If you control the entity that pays you, how can you have a third-party contract apart from entering into a legal fiction where you're the director or boss and you're also the employee? Dividends have their role, and in my opinion, it's another issue that is not understood. And with salaries as well, like I said, the salary on cost should not be dismissed. You have to pay people to set up the Xero file with payroll on it. You have to pay people to have a workers' compensation insurance policy in place. You have to do a lot of other administrative work behind the scenes to set a salary up. And the point of doing that when it's so artificial for a private company is, in my opinion, a waste of money and time.
Yeah. John,
Yeah, I think it depends on the industry. There might be some, I've seen business owners where they might be in a risky industry where they want that workers' comp insurance, for example, and maybe they do a mix. So they pay a certain salary, which is kind of like a base salary, and they pay their super and get the tax taken out during the year. And then when they get to the end of the year, they've had a great year. There's some profit there that they can pull out as a dividend as well. So I think a mix, it depends on the client and also their understanding level. It's very important to...
I'd add to that as well, that another reason why salaries are sometimes used by business owners instead of dividends, which are much more administratively efficient, is for personal financing reasons.
Correct, yeah.
So there are reasons why the fiction of paying yourself a salary through a company that you control is sometimes useful. But in many cases, clients who hit our desk will have been paying themselves a salary without knowledge of the option to simply do a loan dividend scenario over the years when they had no financing requirement. Clients also don't understand that superannuation is now a completely separate issue from your salary or dividend. You can personally contribute from your own after-tax cash into your super fund up to the concessional limit, whatever that may be for you. You may have carry forwards. There may be other reasons why you can make more concessional contributions during a year. You don't need to be in an employment relationship with an employer anymore to achieve the same outcome in a more efficient way than having an employment agreement with an employer. It's just not that way anymore.
No, that's right, Chris. I think you make a really good point. I think if you are operating a mum and dad company where it's a family-owned business or a business through a company, there's probably no point to really process salary and wages. Going through the dividend and loan arrangement, you're saving, as you say, that payroll on cost, that workers' comp, the super, the actual cash outflow that you have to withhold on employees.
And depending on the size of the business, possibly a big chunk of payroll tax.
Yes, that's correct. That's another thing that people don't think about. But those are the reasons why you'd probably go down the dividend loan arrangement if you're a family-owned business. But what you're saying there, where depending on the type of business, I think it bodes well to operate and sort of employ those working directors if they aren't related. That gives that separation of, okay, you're doing X, you're doing Y, you will get paid through payroll at your market value, and then the dividends are then separated and then split evenly depending on the arrangement. So I think both work well, but for clients that are just family-owned businesses, I do think dividends are the way to go.
So we've talked a lot about taxes and operational stuff, but Phil, can you shed a bit of light on some of the common reasons why businesses fail?
Yeah, okay. I think there's a lot of common reasons, but I think the biggest reason as to why a business would fail is because they fail to plan. And some of the mistakes that they make during operating their businesses, I touched on it before. Business owners are good at what they do, running their business, making the sales, but a lot of the times when you're going through that business journey, you focus on too many things. And when you're focusing on too many things, you're not going to get anywhere. All right. The other thing is they don't have the right foundation or a strong foundation in their business. And what that means is they don't have the right systems and processes in place. They don't have the right resource allocation to the staff doing the right things. They don't have a strong accounting system, the record keeping. They don't have all those things in place to be able to grow and scale their business. Another reason why businesses do fail is they don't understand cash flow. You guys would know cash flow is effectively king in the business.
It's like oxygen, right?
Well, that's right. It's the lifeblood. So you need that revenue to come in. But cash flow is king. And I'll leave you guys with a poem. Sales is vanity, profit is sanity, but cash flow is reality. So you always hear business owners talk about how much sales they're making. Oh, I've turned over $1 million. I've turned over $2 million. That's all good. But, you always say something to me, and it's not what's turned over, but what's left over. And so when we look at the P&L, when you look at the bottom line, the profit, that's sanity to realize, okay, we're doing all these sales, but really that's what we're taking home. But in that P&L, it's kind of polluted, right? There's non-cash items that go through that we account for. And so really what's left in the bank account is really important. If you have $0 in your bank account, in the company bank account, you can't pay the debts. You can't pay, your creditors, and you're effectively insolvent.
You're unable to form a solution.
That's right. Touching back to it, to the solve origins, right? So what I'll leave you guys is my secret sauce for success for any business owners, right? So one of my favorite quotes is, your focus determines your reality, right? So step one, you need to have a goal, a dream outcome, what you want to do, what you want to achieve in that short, medium, long term. You write that down. Then you look at where you are now, right? That's your current reality. That gap there, that's the plan. So you can reverse engineer your outcome or your dream outcome back to where you are now in the short, medium, long-term plan. And that plan includes doing a business plan, which includes working out and drilling down what your revenue model is, how you actually earn income, how do you actually, or which income, which customers, which clients, which products deliver the most value for your business to concentrate on so you can be profitable. Once you have that plan in place, you can then set targets, set KPIs so that you can measure that. And you continually focus on those steps until you get to your goal. And that's how you achieve and succeed in business.
Honest accountability.
That's right. I think the biggest thing is, as a business owner, you do need someone to hold yourself accountable. We're sometimes, tunnel vision in terms of what we're doing, but let's take a step back and see the progress. Speak to your business advisor or your partner to go, have I made any progress? Hold me accountable for the things that I said I was going to do. And the biggest thing and the key to any successful relationship is communication. Communicate with your business advisor, your tax accountant on what you are doing to make sure you're on the right path to success. All right, thank you, Solvers. That's all we have time for today in this episode. We covered quite a lot today, but please join us for the next one where we cover more frequently asked questions from our clients. Thank you. If you liked or loved what you heard from us today and want to get in contact with us, please email us at podcast@solveaccounting.com.au or head to our website and fill in the contact form. Thank you and see you next time.